Beneath the glittering skyscrapers and the endless scroll of stock tickers, a shadow market has grown to an unthinkable size. It's not stocks, not bonds, not real estate. Its value is a staggering $600 trillion. That's more than 6 times the entire world's economic output. This market doesn't trade in things you can touch, like gold or oil. It trades in something far more abstract and infinitely more dangerous: risk itself. Most people have never heard of it, yet it's a force that has already brought our world to the brink of collapse. Remember 2008, the year the global financial system almost ceased to exist? That was just a preview. The weapon that caused it wasn't dismantled. It was polished, expanded, and supercharged. Today, it's 10 times larger, and the safety features are weaker than ever. Back in 2008, it all started with something seemingly simple: mortgages. But when the housing bubble burst, a hidden amplifier turned a market correction into a full-blown financial apocalypse. That amplifier was the derivatives market. Suddenly, titans of finance like Lehman Brothers simply vanished. AIG, one of the world's largest insurance companies, imploded overnight. The entire system was seconds from flatlining. To prevent a complete societal breakdown, central banks were forced to conjure an unimaginable sum of money out of thin air: $29 trillion. It was the biggest bailout in human history, all to save us from a monster of our own creation. The lesson from that near-death experience should have been crystal clear. You destroyed the weapon that almost killed you, but that's not what happened. Instead, the architects of the system gave it a fresh coat of paint, added a few more complex gears, and called it financial innovation. They rebuilt the doomsday machine, bigger and more volatile than before. And now it's ticking again, louder than ever. So, what exactly is a derivative? At its core, it's just a contract. Its value is derived from something else, an underlying asset. This could be anything: the price of a stock, an interest rate, the cost of oil, or even the weather in a specific city next year. Originally, they were designed as a form of insurance, a shield. A farmer could use a derivative to lock in a price for their wheat, protecting them if prices fell. An airline could hedge against rising fuel costs, ensuring they wouldn't go bankrupt if oil prices spiked. It was a sensible tool for managing real-world risk. But then, the Wall Street wizards discovered a new game. They realized they could use these contracts not just to hedge, but to gamble. They started making massive bets on the future prices of assets they didn't even own. The shield was reforged into a sword. And with this sword, they could generate mind-boggling profits from tiny fluctuations in the market. The key to this alchemy was leverage. Insane amounts of leverage. Imagine a single derivative contract, a swap with a notional value of $100 million. That's the amount being bet on. But to enter that bet, a bank might only have to put up $1 million in actual cash as collateral. That's a leverage ratio of 100 to 1. It means for every dollar of their own money, they are controlling $100 in the market. This creates explosive potential for profit, but it also creates an equally explosive potential for loss. If the market moves against them by just 1%, that $1 million in collateral is completely wiped out. Gone. If it moves 2%, the bank itself might be insolvent. Now, take this one, highly leveraged bet, and multiply it by millions. Stack thousands upon thousands of these interconnected contracts, weaving them through every major bank and financial institution on the planet. Link them across continents, currencies, and asset classes. What you've built is no longer a market. It's a financial doomsday machine, a web of hyper-concentrated risk where the failure of one small component can trigger a catastrophic chain reaction that brings the entire global system down. It's a house of cards built on an active fault line. You might think this risk is spread out across hundreds of banks worldwide, but it's not. The reality is far more terrifying. The vast majority of this $600 trillion web is concentrated in the hands of just a tiny handful of institutions. In the United States, just four banks hold the keys to this kingdom of risk: JP Morgan Chase, Citigroup, Bank of America, and Goldman Sachs. These are the so-called too-big-to-fail banks. Let's look at the numbers, because they are truly staggering. JP Morgan Chase alone has a derivatives exposure of $54 trillion. That's more than double the entire GDP of the United States. Goldman Sachs is sitting on $47 trillion. Bank of America and Citigroup have tens of trillions more. The official line from these banks and their regulators is that we shouldn't worry. They claim their positions are hedged, that their bets effectively cancel each other out. They present complex models showing that their net risk is minimal. But this is a dangerous illusion. Many of these hedges are with each other. Bank A hedges its risk with Bank B, who hedges its risk with Bank C, who then turns around and hedges with Bank A. It's a circular firing squad. They've created a tightly woven, inescapable chain of dependency. The system isn't robust, it's brittle. It's a closed loop of mutually assured financial destruction. If one of these giants begins to stumble, it won't fall alone. It will pull the others down with it, creating a domino effect that no central bank on earth can stop. It's not a question of sophisticated risk management. It's a question of physics. When one link in the chain breaks, the entire chain fails. And right now, the ground beneath this fragile structure is beginning to shake. There are at least 5 major fault lines that are actively shifting, any one of which could trigger the next great financial earthquake. First, interest rate volatility. Nearly $500 trillion of these derivatives are tied to interest rates. For over a decade, rates were near zero, but the Federal Reserve has slammed on the brakes, cranking rates up from 0 to over 5% in record time. This has sent shockwaves through the system, causing massive, unpredictable swings in the value of these contracts. Second, the commercial real estate crisis. The pandemic changed the way we work, leaving office towers in major cities have now an estimated $2 trillion in commercial real estate loans are coming due, and they have to be refinanced at interest rates that are 2 or 3 times higher. As landlords default, the losses will cascade onto the balance sheets of the very banks holding all these derivatives. Third, the instability of European banks. We already saw the collapse of Credit Suisse, a bank once considered a pillar of Swiss finance. Now, all eyes are on Deutsche Bank, which has its own derivatives book worth around $40 trillion and has been considered the sick man of European banking for years. Its failure would make Lehman Brothers look like a minor tremor. Fourth, sovereign debt. Major world governments, including the United States, Japan, and many in Europe, are drowning in record levels of debt. As their ability to repay that debt comes into question, it threatens the very foundation of the financial system, which is built on the belief that government bonds are risk-free. And fifth, geopolitics. A conflict over Taiwan, an escalation in Ukraine, or a wider war in the Middle East. Any one of these events could be the black swan, the unpredictable shock that ignites the fuse of this $600 trillion time bomb. Each of these fault lines is a crisis in its own right, but they are not happening in isolation. They are converging, creating the conditions for a perfect storm, one with the power to unleash a financial hurricane that would dwarf 2008. For 15 years, we bought ourselves a fragile stability with the magic of cheap money and endless bailouts. Every time the system faltered, central banks rode to the rescue, printing more money, lowering rates, and kicking the can down the road. But each rescue only inflated the bubble further, making the next inevitable collapse even bigger. Now, the machine is running out of fuel. The age of easy money is over, and we are entering a new, far more dangerous era. The age of illusions is coming to an end.